when it comes to options, okay, these are kind of the things I look for. And I'll give you some notes because honestly, I've done a couple of videos on options already, and I highly suggest to watch those, but let me at least give you a brief overview. The reason, all right, the reason I like to trade options is for these reasons. Number one, I'm looking for low risk, high reward setups. That's no matter what asset class. Okay, that's universal. Doesn't matter what asset class. I'm looking for low risk, high reward setups. Now, in options, the risk is predefined. Well, in some of them, they're not. But what I look for is basically OTM calls or OTM puts. OTM calls or OTM puts. Now, OTM means out of the money. It means out of the money. The reason that these options are cheap, relative, is because you're basically saying, let me give an example. All right, don't trade this because you're going to lose money if you do this. But let's just say I think the market is going to make a new high. 524.61. Maybe I think by Friday of next week, it'll be above 524.61. So you would basically go, all right, the contracts are usually based around whole numbers. So it would be, the strike price would basically be 524 or maybe 525 usually. So, you know, one of those two contracts. So what I would do is say, all right, I'm going to purchase a contract or multiple contracts at the 524 level. Okay. By the time, what did I say, Friday of next week? That's the 12th. So basically Friday, I think it's at like right at the open or close to it. I usually don't hold to expiry, but I'm basically saying, all right, the market is going to do what? At some point, trade higher, and I'll close my position and make money. Again, the reason that the options are cheap is because the market has to basically go that distance by the time that options contract, you know, expires in order to make money versus something that's like down here. I can buy a contract at the 514 price level saying that, yeah, it'll be above 514 by Friday of next week. That contract is going to be mad expensive because you're already in the money by far relative. You know, you're up $5, you know, on this ETF. Does that make sense? So it's going to be a lot more expensive and the risk is not going to outweigh the reward on that. So what I mean is, let's say you think it's going to long. You could say, okay, this contract, let's just say is 25 bucks. So this contract down here is probably going to be like 150 or something like that. It'll be exponentially more expensive because it's in the money. Now, what'll happen is, let's say we bought it today. Something happened over the weekend and we gap higher. So these $25 contracts are cheap because it's not there. Once it gets there, this $25 contract now becomes like $150, $200. You know, something to that effect. So you're risking 25 bucks because if that expires worthless, you lose the whole thing. That's it. So if you bought two contracts at $25 a piece, right, you basically put in $50. And if it goes down and you hold it to expiry, you lose it all. Okay. So when it trades higher and you basically get that premium, especially if it does it fast, you make money. Okay. So I'm looking for, did I delete the text already? I'm looking for low risk, high reward setups. I typically trade OTM calls or puts because it offers a nice risk to reward. And again, you can do this with stocks and all that, but it's the pricing of the options is going to be based on the price of the stock and other factors like the Greeks and shit, which I don't know all about. But if I want to keep it simple, I typically just trade SPY, the triple Qs, or the Dow Jones. I usually don't trade Dow. It's usually going to be triple Qs or SPY. Here's a key. One of the keys is volatility, which is another fancy word for movement, like fast movement. So I'll give you an example. You know what we saw yesterday on Thursday. What did we see? A massive sell-off in the PM session. Thursday was very volatile to the downside. So anybody who was short prior to that, they killed it going lower because it was so fast. It was exponential. It was aggressive. Now pause here for a minute. Well, damn. All right, John, how do I get those? Go back and watch that stream we did a couple weeks ago. The trade that everybody wants. That's the second leg of accumulation or the second leg of distribution. Is it all starting to connect for you now? All the streams are interconnected. All the concepts are interconnected, like a spider web. You might not think dollar has to do anything with the stock market, but there's a connection. It's all interconnected. And the concepts will not, you can find the setup where you have a conflicting bias. Maybe you have equal highs and equal lows. In that instance, things are not going to align. But there's a reason why the mitigation model is the way it is. Other models are the way they are. Because you're getting in alignment with price, with order flow. So that volatility here, that was part of essentially the finesse. Because we talked about that. On ES, we talked about how Thursday of last week on the daily, this made a higher high and the other indices didn't, right? So we expected what? Lower pricing. So I didn't short this. I did on demo on Thursday or Wednesday. One of the fucking days in here. And it sold off very, very aggressively, right? That is what is going to exponentially make you a lot of money if you get it right. And that was the last thing, which I said a minute ago. And that was the last point. And I jumped ahead of myself. I said this earlier. What I'm looking for is a strike price that's close to the equal highs or the lows or the target. So there's a few things that you got to take into consideration. The bias is one. Are you going to long or short? Then it's going to be, I'll leave this up here for a minute. You need to decide if you're going to long or short, right? Put options to go lower, call options to go higher. Then you got to pick your strike price, which means what price do you think it's going to trade to and above, really, because you could pick any of them. If you wanted, okay, what the options chain is going to do, it's going to offer options pretty much at every level, 520, 521, 522, you know, so on and so forth. And I know it's not exact, but I'm just trying to be a little bit more thorough for you. So the further you go away, meaning like the further prices away from your strike price, the cheaper it's going to be. So the options up here could be super cheap, fucking 20, 30 bucks, 40 bucks or something. And if it really goes your direction like this, that 40 per contract turns into like 200, 300 a contract. It's nasty. I mean, you literally can 5x, 10x like that trade. So think about that. If your full risk is 1% and you 5x, that's a 5% gain. You see what I mean? And like, that's the kind of things I go for. Now, sometimes I'm wrong, or maybe it goes to my target, but it doesn't do it with enough volatility. So instead of making 5x, I make like 2 or 3. Okay, I'm still going to take it. You know, it's still going to be profitable. But that's pretty much the basics of what I'm looking for. So let me give you a better example of like as far as like an actual trade goes. When I was saying, hey, I think, you know, we could trade higher, but I'm not longing this. Because, you know, this could be a potential mitigation. Actually, that was on Wednesday's open, but it's fine. So if I think, hey, you know what? If price trades through this and back into it, I think this could be a mitigation to go higher. And this gap fills at 522. You could say, all right, I'll buy it here and I'll hold for 1 or 2 days and I'm looking for 522. So you go, okay, I'll buy it here. Not sure what the price, it could be 20, 30, 40, 50 bucks. I don't know. And if price gets here, if it gets to that low, I'll just close my option. So I might say, let's say 100 bucks. But if it goes down here, it might be like 60, 70 bucks. Okay, cool. I'll just stop. I'll get stopped out, lose 30, 40 bucks a contract. Not a big deal. So you're in profit by the end of the day, a little bit. Next day opens and trades higher. So if you had held that, you know, if it's going your direction, that's when you're going to make money, especially like here, that 9 a.m. candle, how it trades higher, like that right there is a good TP. Right then and there, that like 5-minute candle right there, that's good. That's what you want to see. Because you're going to get the difference in price, obviously, but you're going to get a volatility premium as well. It basically, it's like a supercharged, it's beneficial. All right. So that's probably not the greatest stream I've ever done on on options, but that is the one, that's the one thing that I look for. Okay. I'm looking for basically that. Okay. Low risk, high reward setups, out of the money on the indices, you know, second leg accumulation, second leg distribution, something to that effect. And I'm targeting equal highs, equal lows. And I'm usually going to go with a strike price. This will be the last thing I'll say, and then we'll have one more conversation before this weekend. I typically think it's better. Let's say the high is at 524.61. And you go, okay, well, I want to trade an option contract, but I don't know if I should trade 524 or 525. You know, what should I do? Which one should I pick? What I would usually do is the one that's at 524. Because what will happen is if this goes higher, if it's going to run liquidity, it's going to do it very fast and aggressively. And when you get volatility, that's good. You get your price movement, that's good. But you also have it to where it's going, it went from out of the money to in the money. And the further it goes in the money, like deeper in the money contracts, it's just exponentially better. So it would be easier, I think, to have the strike price that is just below equal highs or low resistant highs or something like that.